Good morning, everyone, and welcome to this morning's webinar for the London session. And as always, just before we get going, can I draw your attention to the disclaimer that I know you can see on your screen? As you know, this business can be extremely risky, so please don't ever think of using money that you cannot afford to lose. So those of you who come along regularly, we're going to do something slightly different today. We're actually going straight to the charts and bring in the other bits and pieces that we normally highlight at the beginning of these sessions as we go through the session, because what we found is a lot of people join us at different times and basically miss what we say at the beginning, and they get sort of, saying, oh, what's going on? What do you mean by volume price analysis? What are the indicators? So we've decided to do something different today. It may or may not work. We shall see. If it doesn't, then we'll have to rethink it. There we are. Right. As always, David is sitting next to me. If I just put that down, we've both been looking at the charts this morning since about 5:30, David, 6 o'clock, something like that. Yeah. Anyway, as always, we will start with the currency strength indicator to look at where the flows have been going into both overnight, longer term, and short term. The timeframes that I have here at the moment, I've got the 3-minute chart up here. I've got the 12-minute, I've got the 1 hour, and I've actually got the daily because we've actually got a really nice setup on some of the pairs that we've picked out this morning, which actually help to explain this this paradox, this contradiction that new traders seem to find when they look at charts. When they look at one time frame, a pair, a currency or a pair may be doing one thing, and when they go down to the chart of their that they like to take the trade on, it's doing something completely different. So you have the price action going in one direction, and you have a counter to that in another time frame. And as a trader, really what we have to do is first thing we have to get to grips with is, well, there's lots of things we have to get to grips with. One of the things we have to get to grips with is what are the time frames you are going to focus on and you feel most comfortable with. And in fact, we had an email about that from one of our quantum users who has bought the renko indicator that we have produced for MT5. This is the MT5 platform, and as you can see, it's got some, it has, if you're not familiar with it, it has many more time frames than you have available on MT4, and it's one of the reasons I like to use it. And basically the renko indicator, and I'll show you and I'll explain how it works later on. First of all, how it worked in relation to the move that we had yesterday at the FOMC, before, during and after the FOMC, and also what it's been doing with a couple of the pairs that we've been looking at this morning. And essentially the question that came through, he bought what we call the renko indicator for MT5, fantastic indicator, works on fixed values and what we call ATR, which is average true range, where the indicator comes up with the optimal setting for you. And he discovered that in using it, scalping wasn't really for him. And he then decided that he wanted to use it more in a swing setting, as it were, which is fine. The problem is that he then set it to post a value of 50 pips, and couldn't understand why there was only one brick being posted over a great long period of time. Well, the renko indicator is designed, it only records price action, or it's the most fantastic indicator for helping us to deconstruct, if you like, the condition of the chart. Is the chart in consolidation? Is it reaching a point of, is it going to break away? Is there a chance for a breakaway trade? Are we looking at a potential reversal? But obviously, if you put a huge value on this, the size of that renko brick, then you just have to be patient, because renko doesn't operate as a time chart. It just looks at the value, the number of pips going through the market. Now, whether it's suitable for, at 50 pips, I don't know. You will have to judge for yourself, because the other issue you have to look at is, well, are you applying it to a pair that it, maybe only moves 50 pips in, I don't know, in a day, maybe in a session, in 2 sessions. So first of all, you have to understand, what this indicator, what it's been designed for, and optimize it and leverage it for your trading. But it also brings us back to the topics that we've covered in a couple of the past webinars, and that is recognizing the C state, the condition of the chart that you are looking to trade. That is if you have specific pairs that you like to focus on in the different sessions, or are you like us? Are you like David and I? We just look at our indicators, we look at the charts, and we think, do you know what's moving at the moment? And it's clear. As I said, we look at the 1 hour chart here. Well, we've got the pound. There's been some pound buying this morning. We've got the dollar, which was heavily sold off after the FOMC. That's had a bit of a turn. If we look up here, we've got the Aussie and the Kiwi. They're sort of turning over in this time frame. So there's obviously been some Kiwi selling and certainly some Aussie selling. How is that represented in the actual pairs itself? And this is where I have a little trick here, where I actually put our second indicator up, which is the matrix, and that actually tells me in this time frame where this flow of money is going to in this particular currency and into what pairs. And we've actually got here, we've got cable here, we've got pound New Zealand and pound Aussie. Now, it's not surprising to see moves in the commodity dollars. We've got here the Aussie and the Kiwi, because we're coming out of Asia Pacific. These are the local currencies, and they would have had, they would have been center stage, if you like. Now we're moving into Europe and London. Is that selling going to carry on, or are we going to have a reversal of sentiment? The chart will tell us. And of course, we've had fundamental news overnight, not very good news actually from China. We've had the PMI data not coming as good as, not coming in on target, slightly below. And it's kind of been ignored by the market. The Nikkei posted, I think it all going up to another high, David. Yes, I think the Nikkei was, that kind of followed on from Wall Street. It's been a busy time overnight, because we've had the BOJ as well. Now, but looking at this chart multiple time frame very, very quickly, we see here, this is my time window, if you like, my 1 hour, because this is what I focus on: the hour, the 3 minute, and I've got the 12-minute here. And I look at these lines and I see there's been a bit of dollar buying now. The Aussie and the Kiwi are turning over. But when I look over here on the daily chart, I actually see this is either some kind of pullback, some kind of correction against what is happening on the daily chart. The daily chart is interesting to me because it gives me some sense of context. It tells me, what things are, what the situation is longer term. But it also highlights that, if I am going to take a trade against the longer term sentiment and bias of this chart, then first of all, I have got to be I've got to be very precise in knowing what I am doing. Is the chart in the faster time frames actually set up in the correct way for me to be able to take the trade against the sentiment and bias that is being displayed on the daily chart? And that is perfectly acceptable. That's the first thing. Secondly, is there going to be enough of a move in the fast time frames charts, simply because some pairs are more volatile in the sense that they have a wider breadth, a wider range? That's the second thing. And thirdly, I've also got to be aware of, if I am going to take this trade, all things being considered, what is the risk on that trade? Is that trade, and that means basically, how much am I going to put in terms of contracts? You may reduce, because the way you assess you've assessed the risk, you're still going to go ahead and say, yeah, I know it's a risky proposition going against the bias that maybe is in the slower time frame charts, but I'm still prepared to take it because I look at the chart is in the right condition for me. It's either a breakaway or a reversal, which is fine. So therefore, how am I going to play this potential trade? One way you're going to play it is, are you going to put down, you know, there's say maybe you put with micro contracts it's easier. So maybe you say, well, if the trade was in a different setup, I would normally say put 3 contracts down, but this time I'm only going to try 1. So you put down the smallest amount possible, because, as I said, the risk is greater than if you had a different setup. So as I said, all sorts of factors to consider, but we start here with the CSI. These are those of you who, I know we've got quantum users here from quantumtrading.com. I'll put up the website later on. You'll be able to see where you can find information, more information on these indicators and what they can do for you. The CSI and the matrix, or the CSI in particular, gives you a whole raft of information very, very quickly, and saves you the tedium of having to look at 28 pairs simultaneously, which is almost, as you know, which is almost impossible. What it also tells you is a lot of traders, obviously, they immediately focus on obviously what the dollar is doing, and secondly what the yen is doing, but often some of the best trades that you can find, certainly off the 1 hour chart and the faster time frame charts, is actually in the cross pairs. And those of you who follow my Facebook page, Learn Forex Trading, will know that I've been writing particularly about the Euro New Zealand, and the one that catches my eye at the moment is actually I'm going to be looking at the pound Aussie. There's been pound buying, Aussie is selling, and when I go down to my faster time frame charts, and I can see here the 12-minute chart here, yes, the pound is reaching a point of exhaustion on this time frame. It's been bought quite steadily this morning. But what I'm also interested in is the Aussie. The Aussie is still selling off. So the dynamic, if you like, in this pair is being driven at the moment by pound buying. But because the Aussie hasn't reached the equivalent, if you like, a point of exhaustion down at this point in the chart, there could be some potential for further, if you like, not so much further gain in the pound, but more selling off of the Aussie. And this is another way that this indicator, you know, tells you, gives you that information literally just at a glance. Right, I'm just going to set up my charts just to see whether they've actually played out as I've suspected. I've actually got the Euro Aussie up, the Euro New Zealand, and I've also got the pound Aussie up, that I haven't looked at for the last 20 minutes or so. So I'll go and see what's been happening over there. And in the meantime, I'll pass over to David. If you've got any questions on anything we say, either the indicators, charts, then please, you know, just drop a question into the chat box, and either David or I will answer you.
Thanks, darling, and a very warm welcome to you wherever you are in the world. Hope it's a little bit warmer than it is here. It's absolutely pouring down and grey and miserable, but you know, that's what we used to for 6 months in the UK. It's just what we have to live with. So I hope it's nicer where you are. Good to have you with us, and thank you for taking the time. Sorry, Dave? You can do. We're just going to switch over onto Ninja just while Anna gets hers set up. So let's just pop that up. It should be coming up now. This is on Ninja Trader 8, and I've got the 6 time frames. I've got the 15-second up here, which is very quick. It's not an endorsement that you should be using this particular time frame. All I would say is if you're learning volume price analysis and you want to use a fast chart, and you've got Ninja Trader, even if you haven't, if you're MT4, then use a 1-minute chart. It's a great way to learn. It keeps you sharp. It forces you to read the signals quickly. I'm literally eyeballing this as I'm talking to you. So that's on 15-second. I've got this on 5-minute. This is 10, and the bottom string is 15, 60-minute over onto serve time frame and down onto daily. And if you remember on the CSI, in fact, I'll pull it up in a minute. I've just been tracking this one for, as Anna said, since we got up, really, just to see what the sentiment is for the commodity currencies, for risk in particular. I'm sure some of you know, certainly on the program, you should know anyway, the Aussie Yen is a proxy for risk. So it will tend to reflect that purely because commodity currencies tend to be viewed as risk currencies, and therefore buying and selling of those will generally relate to the broader risk-on, risk-off sentiment across the indices. And I'll hop over there in a minute. So that's one aspect to it. It's not everything, obviously, but certainly when we get Chinese data, as we've had overnight, has a huge impact on commodities, and particularly with the Aussie, which is one of their major trading partners is China. So it has a massive, massive impact, not only for the Aussie and the Aussie Yen, but also in terms of indices themselves, also globally. It's a nice steady move at the moment. You can see on the trend monitor, this is on 15-second. The reason I like having this very fast chart up is because it gives you a heads up as to what is the sentiment. If you remember back to Anna's initial setup of the CSI, the Aussie was up at the top on the hourly and the yen was down at the bottom. That might be a 1 minute, might be could be 15-second on Ninja, could be a few minutes, hours, whatever it may be. That's where my eye is always drawn to. I'm always looking at the extremes purely because I like to get in early. I'm prepared to take the extra risk. The extra risk is financial because you have to set wider stop loss if you're looking at it from a reversal perspective. The payoff, of course, is you get in much earlier. If you're going to jump on trends, once the trends are underway, then the risk profile is much lower because you don't have to lay out so much financial risk on the table because your stop loss is tighter because that trend is already moving. The analogy I always use is that of a train. A reversal trader, you're sitting on the train, you're waiting for the train to leave the station, so you're maximizing your journey. When you jump on a train that's already underway, maybe at the next stop down, to expand the analogy a little bit maybe, but if you jump on a moving train, then it's already underway, your stop loss is that much tighter, but you don't maximize the return potential. And that's what it comes down to. Everything in trading is about a payoff. It's about risk and reward. If you put more risk on the table, you should expect a greater reward for putting that risk out. If you're prepared to put a lower risk on the table, then the reward is equally that much lower. So the trend monitor's red. It's very bearish, obviously on 15-second. That's rippled through onto 5-minute, because what happens in any trading situation is where you've got changes, where you've got breakaways, trends developing, whatever, it will start on your fastest chart. It will ripple through. Now we're on to the 5-minute. You can see here the trend monitor, as I'll just pop that up full size. There we go. Has transitions through. We're in bearish territory. We're starting to see a pickup in volume. And bear in mind on Ninja, this is 7 o'clock our time, so this is the open of Europe. This volume over here is through Asia. But what will happen at 8 o'clock when London opens, the volume will spike and all this volume here will be compressed. But it gives you an indication that all volume is valid. You just have to compare like with like. So if you're trading Asia, which I have to say is probably quite tough, then you're comparing the volume through here. Once we get to 7 o'clock here, you've got to remember that this volume is all comparative, but you can't really compare it to the volume over here because it's a different session time. And so the same will apply as we move into London, the volume will pick up. Starting to break away from the volume point of control, which is up here. When the price action is around the volume point of control, then it's in price agreement. In other words, using a market profile terminology, there is no imbalance in bearish or bullish sentiment. So you find the heaviest volume. Oh, have I not switched my microphone on? Yeah, I've got my mic on. Can you not hear me? Oh. Can anyone hear me? No audio. Oh, terrific. Can you hear me now? No, it's my connector. No. Yes, I can hear you. Thank you. Audio fine. Thank you very much indeed. Sorry. Sometimes I forget to switch my audio, which is very frustrating. On this occasion, I haven't. So hopefully you will have heard me. I'm sorry, Summer555, if you've not got audio. Can you hear me? Yeah, it's my connector. I think it's Anna's connector. We've got some dodgy jack plugs here on our headsets. So apologies, but hopefully, thanks, Michael. Thank you, Ashley. Thank you, Stephen. Thank you, Tony. Brilliant. Thank you. Thank you. Thank you. Thank you. Okay. Right. We'll carry on. This is the volume point of control, this yellow dashed line, and you can think of that as the fulcrum of the market. At that point, the market is in price agreement. In other words, there's no sentiment one way or the other. Bearish and bullish sentiment is pretty much equal. Once the market develops a sentiment to one side or the other, then the market breaks away, and what you're looking for then is volume, confirmation with volume of a move away from that region. and of course supported by the indicators. And what we're looking at down here now in terms of the volume profile, this is the heaviest concentration of volume, which always sits at the volume point of control until the next point develops, at which point it'll move. This blue line up here is a dash line on the accumulation distribution indicator, which works on price and is giving you a perspective on price-based resistance or support. The thicker the line, the heavier it is. That's the way the indicator works. It's extremely sophisticated. It's looking at the number of times a level is tested and holds, and each time that happens, it thickens accordingly. So the thicker the line, the more dense that particular region is. You can look at volume in the same way down here. We've got the volume histogram, and what's happening here on the 5-minute chart is we're moving down into an area of low volume on the volume point of control. What that means to you as a trader is that all things being equal, the price action should move through there fairly rapidly because there's very little in the way of volume. In other words, not only volume that's been transacted at that level, but also old orders. And another aspect to it, which is a little bit more subtle perhaps, is that if the market didn't consider it important in the past, it's unlikely to consider it important now. And therefore, why would it stop at that particular region? No particular reason that it should. So we should expect it to move through there fairly rapidly. This is on the 10-minute. You can see here the trend monitor again, bright red. What we're also seeing now, and it's another reason, again, this is another question we get a lot, is, and I'll choose my words carefully here, because when you're trading, what you're looking at is defining your time window. So if you're a scalping trader, you have to restrict yourself to what it is you're trying to do in your 1, 2, 3-minute combo, or 1, 5, 15, or whatever it may be, and not to flip that trade because it didn't work out in that time frame, to push it over onto another and say, oh, well, it didn't quite work out there, but if I look at an hourly chart or a 4-hourly chart, I think I might be all right. So, let's let that one run for a bit. It's very hard. You have to stick to what it is you set out with as your initial trading concept and idea, the tactic you were employing and the time frame you were employing it in. That said, when you look at slower time frames, it's important to have multiple time frames for so many different reasons, but not least because they give you a different perspective on things which may or may not hinder progress. And this is just a classic example coming up right now. Just move the chat box out of the way. Again, we've got the volume point of control here. We've got this very strong resistance here, which was tested, retested. It kind of crept through, but it never really held. You'd obviously be looking at the volume in that case. And if you're looking at it as a breakaway trader, it's always a judgment call as to how far away from a congestion phase you are comfortable getting in. I can't give you an answer to that. You just have to make that decision for yourself. There may be levels which make it very clear. They may not be. What's happening right here now is that you can see this level here, which is coming into play. This is a support platform. And remember also that the slower the time frame, the greater weight will be carried by that time frame. So anything that you see on a slower time frame will carry much more weight than something on a faster time frame. It's logical, it's common sense, but a lot of traders don't think of it that way. So if you see support and resistance on a 15-minute chart and you're trading on a 5-minute chart, the 15-minute chart will carry more weight than the 5, purely because it has the added weight of time, because time is everything. Time builds strength, it builds importance. So what we're seeing here is a level that's coming into play as a potential support region. The market may or may not hold at this, but when you're scalping and you see this on the horizon, it gives you a heads up as to answer that question that we always have in our minds, which is, why has the market done that? Which is the first question. Secondly, what is the reason for it? And third, how long is it like to be there? And is this important? If that breaks, obviously that is going to become resistance. But as you can see there, it's hopping around. That is acting as support right now. But again, it comes back to your time horizon. If you're looking at this, if this were let's say you were doing a 10, 20, 30-minute time horizon, you were looking out maybe to the hourly for context, then the fact that this market is hovering around here is probably of less significance. And what you're looking at is, if the market breaks below this, what have I got in the way in terms of the trading opportunity to the downside? You've got another layer here of very strong support, which is likely to come into play. This is only a handful of pips. This is 10, 12 pips, remember. And then if you break through that one, you've got pretty much clear water. So if you're looking at this as a longer term perspective, you might well take a view that what I'm going to do is I'm going to wait for it to break through here. If it breaks through here, I've got very little in fact, I've got nothing in the way of price support, which is going to come into play. And I've got a nice low volume node here, which should help to push it through there pretty quickly. Now you can see what's happening. It's starting to bounce, it's starting to rally off that. Bear in mind also that we're now coming into the London Open. And another question we get is, well, how far ahead of a session crossover should I trade, or should I not trade? Or if I have positions on, should I close them out, etc., etc. Again, there's no law book, there's no rule set that you can say, well, I'm going to stop trading, or I'm not going to trade, 20 minutes before the open or 10 minutes before the open. It just doesn't work like that. Every situation is different. All I can tell you is that as you come into the session crossover, particularly the London crossover, which is the deepest liquidity of all markets, it's massive. It's something like 7.5 trillion traded through London. It's a huge market. The volumes are massive. And what you will inevitably see at every single crossover, but particularly for London, is what we're seeing right now, which is volatility. Purely because it's the ideal point at which the market makers can step in, make some very quick money with traders who don't understand what's going on. And the reason for that is very simple. You'll see volatility, you'll see reversals everywhere, you'll see trap moves going on because it's so simple. What this is telling you is you've got, the market makers are in there, a nice rapid move higher, and then bang, the reversal comes. It's the power of the volatility indicator. What it does is it's looking at average true range all the time. In other words, it's looking at what is expected in terms of the price range on a 15-second chart for the Aussie Yen. Because what average true range does, it looks at it over a number of bars, and if it moves outside the average true range, then it signals volatility. And all volatility is just a compression of time, because this price action here happened rapidly, but it was compressed in time. And that's the only difference. And the reason it's so powerful from a market maker perspective at any rate is because it triggers the fear of missing out. You as a trader, your instant reaction once you see a market moving rapidly like this would have shot up and you would go, oh, I'm going to jump in, make some quick bucks. No, it doesn't work like that. That's playing for the market makers. That's what they do. The volume here tells you that. The trigger comes in on the volatility indicator. This triggers in real time. So you don't actually have to wait for the candle to close. And now we've got a full-blown reversal. So when these come along, 8 or 9 times out of 10, you'll get one of two things. You'll either get congestion, which is another emotional squeeze used by the market makers to trap you in a position and then create uncertainty and doubt in your mind, or alternatively, you get a full-blown reversal. That is what generally happens. Not always. There is no always in trading. But that's the power of the volatility indicator. If you're in a position and you've got profit in there, I've said this so many times, if I have a position and this triggers, I close out and wait, because I don't particularly want to sit through either congestion or certainly not a reversal. So if I'm in profit, that's it. I'll close out. I'll wait for the price action to clear that particular piece of volatility. I can always jump back in. It's as simple as that. If you're in a loss-making position, it's a tougher call. You've then got to decide a very simple decision. Do I close out, or do I chance it and hope that the market actually rallies in my favor? I can't answer that one either. But if you have a position in profit, I would always close out. And if you're not in the market at this particular time frame and this occurs, it's a question of being patient and waiting for the market to settle. We know why we've got volatility, because it's a session crossover, and you get volatility in all sorts of things, news releases, etc., all the rest of it. So it's just a fact of life. The longer term, in inverted commas, trend is still very much in play. In other words, selling at the Aussie for the time being. We've had the market rally. We've got a wick to the upside. Volume is not terrific on there at the moment. It hasn't really gone into full blown. We're just waiting for that to develop. For 10 minutes is still bearish, as you expect, down onto the slower time frame of the 15. This is setting up nicely if you're looking at this as a breakaway trader, if that's your primary tactic. And one of the things we cover in great detail in the program is the choices you have to make as a trader, whether you are going to employ a smorgasbord of tactics, in other words, a variety of tactics, and you're just going to go into the market and you're going to pick a tactic, whatever it may be, to suit that particular chart, Or are you going to become a specialist in certain tactics? Are you going to just focus on congestion areas, which, let's face it, constitute 70 to 75% of price action, because from congestion phases come breakaways and trends. So it's perfectly valid to go into this business and say, I am purely going to trade congestion phases, be a tactical trader on that. I'm going to become an expert in that, but I'm going to go apply it to all markets. Equally, you might take one tactic and only apply it to a limited number of pairs. You might take all the tactics and apply them to a limited number of pairs. Am I a reversal trader? Am I a trend trader? Am I a breakaway trader? Those are the sorts of things you have to sort out, find what works for you, find what you're comfortable with. It also depends how much time you've got available. Do you have the luxury, as we do, of sitting in front of screens all day long? You may not. You may have to go to work. And we always advocate, do not give up the day job. This is a tough business. Do not expect to give up the day job and make money from this straight away. You won't, you'll fail, because the pressure's too much. Just keeping an eye on this as the market breaks lower. And again, it's back to time frames. What are we looking at? We've got a very strong region. In fact, we've got a double region here. We've got a very wide region, and immediately above it, a less strong region in the narrow dash line above it. So you've got a pretty strong cluster here. You've got another level here. And then if you were looking at this as an opportunity to break, well, you'd be worried about this. You'd have to wait for that. If I was looking at this as an opportunity, I'd certainly wait for it to get through that one and probably this one as well, and then jump in, because you've got, you can take a decent number of pips out of this region here before we get down into some lower levels of that region. Yep, so there we go. I'm going to move back to Anna now.
Thank you. Right, I just wanted to pop over here because, as I mentioned earlier, that we were going to look at, well, I've been looking at the pound Aussie, and in fact the configuration of charts that I've got here, which is the renko up on the top left, and then my renko setting, it's actually a fixed setting on this one. I have a fixed 2 pip size to the box, but as I said, you can either set it to a fixed value, which I just happen to be a fixed value, or you can have the ATR use the ATR function, and the indicator will post select the value for you, and the bricks will form accordingly. And this is really interesting because the multiple time frames that we were talking about, what is happening on the different time frame charts, this move has been underway, and in fact we're talking here, it's about 40 pips, which is really something for for a cross pair, and also the instigation for this move came up on both the renko and the 3-minute chart, and we have on the 3-minute chart we have a breakaway from the volume point of control, but on the slower time frame charts we've got the 12-minute, we've actually got the hourly chart, we have also the setup for a reversal trade. So not only on multiple time frames can you see are you looking at maybe contradictions, but multiple time frame charts will also highlight trading setups, if you like, but different setups, but they all lead to the same thing. What I'm trying to say is, David was talking before about, well, I only like to trade a reversal, or I only have a set of tactics, the chart has to meet certain criteria, and then I will take the trade, whether that's Fibonacci, whether that's a candle pattern, whether it's this, that, or the other. That's fine, that's up to you. But what is interesting is, in looking at multiple time frames, you can see different setups, if you like, but they're all leading to the same thing. So for example, if we look at the 3-minute chart for the pound Aussie, we can actually see, if you like, this move that we see here, where it is a let's take this as the primary trend. We had a little bit of a pullback here, and it's not a I would classify that as a trend with volatility. Why? Well, we've got volatility candles triggered in the move higher, and we've also got a lot of wicks to the candles at both tops and bottoms. So it's not a straightforward trend. It's It's as I said, it is volatile. When you have a volatile trend, you've got to be more aware of your stop losses. You've got to be careful if you've got a trailing stop, don't put it too closely, and yet all sorts of risk management issues, and also, as I said, the money management issue as well. But if we look at this move, we have this move sort of starting out here when we've got this hammer candle. That doesn't look like a lot of volume because of this volume here. This is distorted because this is London, and you have to be aware that not all the sessions are equal in terms of participation. So when we read the volume on the down here at the bottom of the chart, you have to be aware of that. Now, at the time, that volume would have been sufficient. It's also on a volatility candle, so there's a degree of momentum coming in. But let's take that as one potential starting point. But the point that I'm particularly interested in is here, is the volume point of control. As David said, this is you looking at a volume through the prism of time. Time in the sense that if you look beyond to the left, this was a point on the chart, it's the fulcrum of the chart, it's kind of fair value where the pound Aussie kind of rotated. If you can see here, it tried to pull away, then it came back, then it kind of moved sideways a bit, then it actually moved away to the downside. Now, whether that was a potential trade to someone who was going short, maybe on the very fastest time frames, I don't know. I'm looking at this from the perspective of moving higher. Talking about volume, going back here, this is the inrush of volume that is inevitable when we get the crossover into Europe and London, particularly London. As I've mentioned before, London has 43% of the 6.6 trillion a day market. Just let that number sink in, 6.6 trillion a day. And I've got the link to to Reuters, who actually came up with the data, and it's based on not broker data. This is from the Bank of International Settlement. So the point I'm looking at is from then we had another attempt at moving higher. Now this is looking, so I like breakaways. I like to know where my volume point of control is on my charts in all my time frames. But if we go back to the 12-minute chart, what we're seeing here, we're seeing a 2-bar reversal. This, if you overlay that candle with that one, you actually get a hammer candle. So on the 3-minute chart, where we looked at the move away, we did have a hammer, but really the strong move was from the volume point of control, supported by volume, lots of buying of the pound. So on the 12-minute chart, what is the chart condition I'm seeing? I'm seeing a strong platform of support at 86.47. I have this nice 2-bar reversal. I've got volume coming underneath it, and the move starts to move higher. Where is this move going to? Well, actually, the 12-minute chart also gives me a potential target for this move. It's probably going to go up to here. Why? Because this is where the volume point of control is on this time frame, which is good to know. David and I don't use fixed risk and reward, and there is an inherent danger to fixed. We know the risk of money that we are prepared to lose, but your reward should be as open-ended as possible, because as I said, on this faster time frame, that move is over 40 pips. If you are then saying, well, I'm only going to risk 10 to make 20, and then what? And then it carries on for another 20. How are you going to feel? If you understand the chart and understand support and resistance, use volume price analysis, hopefully use our indicators as well, you don't have to lock yourself into this. It is a straitjacket, isn't it, David, of this constantly saying, I'm only going to risk this and I want to make that, because you will, personally, I think you will find it hugely frustrating. Now, just a quick look at the chart over here. We don't have a volume point of control at this point. We can see here there's quite a lot of transacted volume. What we do have is, to help us define congestion phases, we have the pivots. I use pivots and fractals. David only uses the pivots that are part of our quantum indicators. The pivots actually highlight, mark out the congestion phase for us. So we know when it's going into congestion, at some point it is going to break away. Markets do that all the time. The question is, how long is it going to be there, and how can we be sure that we are going to break either higher or lower? Well, it tried to break lower here, as we can see here. It hit the support region, going back here, and in fact, because it posted this 2-bar reversal, and because I'm using multiple time frames, and it was reaching the volume point of control also on the 3-minute, I kind of said, you know what, that's probably, you know, the two chart conditions are in alignment, even though you don't get exactly the same setup. So then if you look at the hourly chart, what do we have here? Well, we have a kind of reversal trade coming up on the 1 hour chart. Very early doors. 1 hour, you have to allow this move to breathe, if you like. We know it's a reversal. Why? We've tested this platform here. We had buying coming in here. Then we had a pullback. Then we had another hammer candle. Now we've had 3 candles. If your time frame, if you're looking to enter on the hourly chart, you would be looking at the 4 hour and the daily. You would probably have to let that go because you've only got 3 blue candles. Yes, you've got an inrush of volume there. Yes, you've got this, where is this potential? You've got your VPOC much higher up. You've got a heck of a lot of congestion to, to face as you come here. But the reason I tend to stick to the hourly chart as my benchmark and the faster time frame is because it's got the British pound in this pair. And given what is happening, I know we've got the election now has been settled, so Brexit is not quite the same, doesn't carry the same volatility, does it, David? Because it's all going to be resolved in December the 12th. But you never know, you know, polls come out all the time, comments are made. So, you know, if the market gets any wind or sniff of what may or may not be happening, then you will get the reaction. Maybe, but if not, pound is, you know, it was always a very nice, steady currency to trade anyway. Now, going back to actual entry point, this is where, because I'm on these faster time frames, I use the renko chart, and what I like to see is a definitive a match of the trend dot and the trend monitor. And when I said earlier on the 3-minute chart that this was a trend with volatility, and we can see that because you have volatility candles, you have a retest back down to the volume point of control, and we've got all of this sort of wicks to the candles as we move up the trend. What the renko does, it smooths it out. It doesn't take it out, it smooths it out. And what you are seeing here is reflected. So as you see, we've seen this sort of fairly steady rise, then it goes sideways, the trend dots turn to grey, they don't go red, this stays relentlessly blue, the support comes in with the pivots and the fractal, then we have a support line at 86.74 and on it moves upwards. But you can see the little pullbacks all the time. Can you see the pullbacks all the time? That is reflecting what we are seeing on the time chart. Then we had a little, again, we had this, it tends to pause as it comes into the London session, and now, you know, London does its whatever London does, it tricks, you know, trapping traders on the wrong side of the market. Now, if you had entered here at this point, sometimes with London opening and with some pairs, you have to be aware that sometimes it's prudent, if you like, to close out, or if you've gone in with maybe 2 or 3 contracts, or you've added to contracts as the move has been going on, maybe you take some off the table and just leave 1 or 2 to run and say, well, you know, if I get taken out by the market, I get taken out by the market. Stop losses. Why do I like using the volume point of control to help with entries and exits as well, but particularly entries, is because it is you have a very clearly defined areas of where to put your stop loss. And this is David and I became acquainted with a hedge fund manager who's actually, I think, did Corbyn actually write that book? He did, didn't he? He did a pamphlet on it. Yeah, he wrote a pamphlet on it. He actually did a whole load of back testing on the euro dollar using breakaway and stop losses, and whether it was in terms of the and how efficient it could be at successful trades. And the thing with breakaways, and I think the reason why a lot of traders don't like them, is because you can, if you don't know what you're doing, end up with a series of losses. It won't be big losses, but you will get a series of losses. and traders say, oh, I can't deal with a series of losses. But if they're small and you allow the profitable trades to run, they cancel each other out very, very easily. With reversal trading, you have to allow that that position much more space, because yes, you've certainly got the support platform and the support lines. If you actually the hourly chart, well, let's take the 12-minute chart. As you can see here, where would you put your stop loss? Well, it will certainly be below that support platform, but it could be a lot further away than if you were using something like the VPOC. Now, the reason for the VPOC, why the VPOC is so good, is it immediately tells you this is the area that where we have had this, if you like, fair value, and it's, if you like, it is because of that it is stronger. Now, as we can see here at this point here, you have to look at the histogram behind the chart. At this point here, that there was a potential there. If that while the price action paused at this level and moving sideways, that could have continued. If you look here at the histogram, this histogram is longer than this one. That's where the VPOC sits, because it's the densest area of volume at this price. What the indicator also does, it's dynamic. So if you've missed all this, 40 points, sorry, you know, didn't get up, it doesn't suit your trading, the time that you spent in front of your computer, etc., etc. If this had moved there, you've missed all that. That is a point where you could start, once that you could sort of start from, it's a fresh setup, if you like, using the VPOC. So the VPOC is a great indicator to help you to re-enter a trend, because you know, you've heard all the, you know, all this, the trading saying, don't chase price, don't chase price, you know, it's, you mustn't do that. Well, you're not chasing price, because the condition of the chart has changed. It's moved, we've had a trend, the primary trend, let's call this primary trend. This was a little secondary trend within the 3-minute chart, although the trend monitor didn't change. And the VPOC then moves up here. It's a different condition. We've missed that, that's gone. A train has departed, it's paused. Now is it going to go further up? And we then look at the chart with completely fresh eyes. If you had it with the renko is still moving higher. Now the next question is, where is it going? Well, we have to go to the other time frames. As I said, this is the point here, 87.22, which is where it is very likely to pause. Why? Because it's going to hit an area of resistance that is not just price-based resistance, but volume-based resistance. And this move from here to here, we have, let me see, I did my calculator out, 86.47, and we have 87.22. How many pips is that, David? My math is awful at this time of the morning. What is it? 87.23 from 86.47. 80? 47. Yeah, about 80 pips. 80 pips. So don't tell me that cross pairs don't trend. Don't tell me you can't pick up decent pips on the faster time frames. 80 pips in anyone's language is a nice little bit of profit. How's that, David? Anything you want to say to that? All right, just very quickly, I have mentioned, as I used to say in the old soap operas, our sponsors for this event. David has been saying that I dare you to say it, and I say I will say it. Here we are. Right, AnnaCooling.com. This is me, and these are the books that are up on Amazon at the moment. As you can see here, they're also, this book is translated into Japanese and 2 versions of Chinese. This one is about to be translated into Chinese and Japanese as well, isn't it, David? I think they've got that. So all the details on the books. As I said earlier, this is where you'll find the analysis using VPA, using the indicators. This was the NQ. We've actually been bullish on the indices. We haven't. We talked about it last week. We said, is this a distribution? We said, no, not yet. And lo and behold, what happened? Volume price analysis anticipates what's going to happen next. You know, we use it to look at examples of how it works in the past. Of course we do. because patterns repeat in this business, but it also is a great anticipator of what is likely to happen next. As I said on my forex page, right, this is the as I said, this is the renko chart I put up on the forex trading and how, in fact, we read it using consolidation trends. This was actually a V-shaped reversal, but there was volatility because of what Powell was saying. First, everyone thought he was very hawkish, so the dollar rose, and then everyone thought the sun was shining again, and up it went, and that's what happened with the dollar, as we saw on the CSI. So as I said, you can catch up there. Quantumtrading.com is where all the indicators there. We also building the TradeStation one, and everything we say in terms of what you need to know to become a successful trader, you will find at quantumtradingeducation.com. Psychology, fundamental, related markets, there's all explained there, technical analysis, and the mechanics of trading, which is what I've been talking about when we looked at the. And then we've got what, Dylan?
And you've got all the other,
yeah, we've got all those there. 7,000 slides, so keep you out of mischief over these long winter nights if you're in the northern hemisphere. Can I pass over to you?
Yeah.
David, I'm going to pass it back to David. I want to keep an eye on this one. Of course, it is going to reverse, but we shall see if it offers a trade to the downside as we move into the London session. And the other thing you have to remember is the sessions, particularly I think the London to the New York session, you can have a really nice trade in the morning, and if you're trading all day, by the time the afternoon comes, the chances are there's very high probability that it will. It always seems to. New traders, they have a different view on things. You've got different items of fundamental news. What have we got today? We've actually got Canadian GDP, which we will look at when we do our second webinar later this afternoon. I'm going to pass over to David. I'm actually going to say that's enough from me. He's got things to say, and we will be back later on this afternoon. If you're not joining us this afternoon, we'll be back next week.
Thanks, darling. Hopefully you can hear me loud and clear. There we go. Just back onto the Aussie Yen, just to see where we are wrapping up. This is the support level I highlighted, pretty strong there. You can see it's still bouncing around that. If it breaks below that, then we can expect some further downside momentum for this one. But it's not particularly strong, I have to say. If I go back onto the currency matrix, in fact, before I do that, let's just head over onto, this is the one I always like to keep up somewhere. These are the four indices, got these on 5 minute. This is this is yen at the top left. I've got the dollar at top right here, down at the bottom, euro, and over on the right hand side, this is the pound. And basically that's the pound buying we're seeing at the moment. So we've got it on the 5 minute, you can see it strongly reflected in terms of the index. All these indices are available on all the platforms, MT4, TradingView, and of course they'll be available on TradeStation as well. Some yen buying this morning, risk off, it's not particularly strong. Not a particularly strong move there on the dollars. Yeah, we had some selling dollar early on, bit of buying. It's just not particularly strong. But you can see the pound here is continuing higher. And this is the euro, which is weakening a little bit. So maybe look at euro pound might be one to look at possibly. But just in terms of the pound pairs, just go back onto this is the currency matrix, which I've just isolated out on the British pound. You just click on and off here, and you can see what's going on. And basically what this is telling you very loud and clear is that the market is buying pound at the moment. Doesn't matter why they're buying pound, they just are, because you've got a perfect stack array. All these up at the top and the euro pound down at the bottom. So the pound is universally being bought. So if you are buying the pound, if you're in a pound pair right now, that you are trading with the market sentiment. In other words, the river of pound is buying. No one's selling the pound right now, not in any great volume at any rate. They may be on a 15-second chart or a 30-second chart, whatever. But in terms of the slightly slower time frames, that's what the market's doing. That's the market sentiment. And that's what the matrix does for you, amongst many other things. It works very close to the market. It's a little bit like the trend monitor and the trend dots. The trend dots work very close to the price action. The trend monitor takes a more considered view of the price action. It steps back, if you will, looks at a slower time horizon. So when you get a change in sentiment, that will be reflected first in terms of trend dots, which are very close to the price action, and it will ultimately, if it is a true change, it will be reflected on the trend monitor, which looks at a much longer time perspective to try and help to establish whether it's simply a minor pullback or whether actually it is a true change in the trend. So that's the currency matrix. Works exactly the same way, as I say, very close to the market, and it gives you a heads up on which are the strongest and whether market sentiment is broad across that particular pair. Across that particular currency, rather. Again, got it isolated. This is on 10-minute. Out of the way, get up onto 15. There we are. So that's really what the market is saying at the moment. If we go on to the array, what the array does is a similar thing. It's telling you a similar thing, that the pound is being bought universally. What it's also telling you is strength of trend. Where is the strongest trend right now? It's in the pound Aussie. That's certainly the strongest one right now. And it's also giving you a heads up on this second column here as to whether the pairs themselves, as opposed to the currencies, when you look at it on the currency strength indicator, what you're looking at is whether a currency is overbought or oversold. And what we're looking at here is the potential opportunity for a currency pair to move to an overbought or an oversold situation. When they're color-coded like this with the brackets, that means that they're not quite at that situation. In other words, they're approaching it, but they haven't arrived yet, a little bit like the train hasn't got it to the station yet. Same down here. This is a darker color, and we've got brackets around it. When these move to potentially, and I use the word cautiously, potentially, obviously this is all based on the chart, further analysis, volume, everything else, indicators, but potentially this is moving to a situation of oversold. And when it arrives at oversold, as far as this time frame is concerned, this will go to bright red and the brackets will disappear, and these will go to bright blue and the brackets will disappear up there as well. Yep. Yeah, just to answer your question, Ashley, on Fibonacci and Elliott wave and all these other myriad of ways of trading, what we find is that a lot of our customers will use the indicators, but they'll also develop their own. I mean, there are plenty of people out there who've just bought the volume book. Let's be honest, they buy the volume book and they apply whichever approach they want, tactical trading to their technical analysis, whatever it may be. There is no right or wrong way to trade. We never suggest that. We never say that. There isn't. You have to find what works for you. We've had so many emails over the years that Elliott wave traders have stumbled across volume price analysis, and they've basically it's helped them to understand why it is that the Elliott wave principles work. And actually, when you unpick it all, you find it's a combination of not only that principle, but also the principles of volume price analysis and support and resistance and all the other technical aspects of trading. So it's finding what works for you, because at the end of the day, you have to believe in what you're doing. If you are a Gann person or you're a Fibonacci person and you believe wholeheartedly in that approach, it doesn't matter what anyone else thinks or says. That's what you believe, and that's what works for you. It's as simple as that. It's finding out what works for you. The beauty of volume price analysis is it can be applied to any market in any time frame and any instrument. So once you've learned it, you have something that works for you in whichever way you choose to use it. If you want to use it with other indicators, if you want to use it with our indicators, terrific. If you don't, that's fine. Find out what works for you and just build your own technical or fundamental or relational or combined approach to trading and pull everything together in a way that suits you. Not Joe Blogs next door. It suits you. It's unique to you. It's as simple as that. Just go up onto 15, see what's going on there. Pretty much the same. And what you're looking for now is you're really looking for these to tighten up, for these guys to move up. You can see that there's very heavy buying of the New Zealand right now. Got New Zealand CAD at the top, New Zealand dollar up here. But in terms of pound, you want to see these ticking up here. You want to see these moving up. You want to see this one moving down. This one's pretty low down here. You want to see it moving higher. And what the array does, it gives you that visual on the strength of trend, which trends are developing more strongly, is sentiment broad, Have we got pairs moving into overbought and oversold situations? And then finally, you step down onto the currency heat map, which gives you a slower perspective in one sense and a faster in another. And by that I mean in terms of the ranking down here, what this is giving you is perspective weighted by time. So these pairs are ranked according to the bullish or bearish sentiment across the time horizons, but that time is weighted. So a 4-hour time chart or a daily time frame will carry much more weight in terms of the ranking down here than a 1 minute, which is what, again, it's common sense. It's what you'd expect. If we've got bullish sentiment in 1 minute, it's what I said earlier, the bullish sentiment in an hour is going to carry much more weight than a 5 minute, for example. So these are all carefully weighted to give this ranking of where the currency pairs sit on a slower perspective. They move up and down during the day, but they're not going to go from top to bottom like they would on a CSI. They are going to move maybe 1, 2, 3, 4 slots. And over a 2-3 day perspective, you might find that a pair has gone from the top to the bottom and vice versa. So you can look at these in many different ways. You can look at them for breaking out sentiment. You can look at them for reversal opportunities if you've got, and we used to do that all the time, but you'd be looking at this on a much slower perspective. So you'd be looking at holding these positions for hours and probably days once you take that particular approach. When you're looking at the cells themselves, what you're looking for here, and it applies to all time frames for all traders, is you're looking for the sentiment. What is the sentiment doing? Is it rippling out from the fastest? Are we seeing bullish sentiment building here as indeed we are? It's out to the hourly. Now what we're looking for is for that, if that's going to continue longer term, then we want to see that ripple through to the 4-hour and into the daily. Equally down at the bottom, if I just click that off and stop isolating that, you can see down here we've got New Zealand. The New Zealand pairs have been absolutely hammered lately, but they're starting to turn bullish. And I mentioned it yesterday, I think, on a Facebook post. It's when you see these cells start to turn green and they start to move out across the time frames and gradually filter their way out, that's when you will start to see these moving up. But what this also gives you is a very quick visual on where the bullish and bearish sentiment is. If you're a scalping trader, you're looking down at this level, you're on a 1-5-10, whatever it may be. If you're a slower term time trading, you're looking out, maybe out 30 out this way. So it gives you all these pairs, all these time frames in one consolidated chart, just to help give a perspective on what is going on in terms of the broader market across so many pairs. It just consolidates this in, it just negates the need for having hundreds of screens open, hundreds of time frames. It just gives you that heads up immediately. So there we are. Let's just head back onto the charts again and we'll wrap up there. We're in congestion. That's held. It's holding up. We've got the volume point of control building here. A little bit of buying coming in. Trend monitor still red. Trend monitor still red. We're coming up to this, which was support, is now acting as resistance. So we've got another play there. And in terms of the daily chart, I highlighted this when it was down at this level. Because once it broke through this region, we're going to have a decent platform of support in place, which is what we're seeing right now. It's a bit of a crawl. We're in a low volume node here territory. The broader market sentiment right now is bullish because the trend monitor has been signaling that for some time now. And we're into a low volume node. So all things being equal, in this particular time frame, we should move up through there reasonably easily. But then we've got some decent resistance up here, up at the 76 area if we carry on that far. So there we go. That's it. I'm going to wrap up and run. I'm going to go and grab a coffee. I hope you've enjoyed the session. We do appreciate you taking time to come along and hope you've enjoyed it. Sorry, Anna's just... Sorry? Yes, I'm just going to do it. It's all right. I've got Anna prodding me in the back, as always. Very funny. Just to highlight where you can buy the indicators once more, just on quantum trading. There we go. Just click on any of these, it'll take you to the various sites. You can buy one indicator, you can buy a bundle. The other thing I would say is for a lot of our customers, they start with perhaps one or two over time, maybe buy more. We're always happy to credit you with whatever spend that you've spent with us. We can credit you against the full package, and indeed moving on to the education program. If you've got a handful of indicators and you want to move the education program, again, we can credit you and do it that way too. So whatever you spend with us is never wasted. You can transfer from platform to platform. You can do it free of charge. There's no cost. So as your trading develops, a lot of our customers start on MetaTrader 4 and 5, and then migrate to Ninja, and I suspect quite a few will also migrate over to TradeStation once that's up and running, because it is an immensely powerful platform with huge flexibility. As I say, there's no cost in that. The license for MetaTrader 4 covers both, so there's no cost there at all. All our licenses are for life. There's no other cost. You pay once, that's it. There's nothing else to pay. You get 24/7 support, and upgrades are free, both for platform upgrades and also indicator upgrades. So it's all that. That's it. There's never another penny to pay. And if you go for the full package, the other benefit of going for the full package is you get all future indicators delivered free of charge. And I know the fact that some of our customers who started early doors have had 7 or 8 indicators added for free, paid nothing for them because they joined us early. It's just our way of saying thank you to you for investing in the full package with us. Hope you've enjoyed today. Just drop that out the way. There we go. Hope you've enjoyed it, and we will see you later. We are back at 3:15. We're not on British summertime anymore, so it's a little bit different in terms of US markets. They'll be running for a couple of hours instead of the normal hour, but we will be back at 3:15 UK time. Hope to see you then. Hope you've enjoyed today. Thanks for coming along, and bye for now.